Welcome to another week of the Educated Homebuyer Live. Happy Wednesday. Happy New Year. Before we get started today, just want to take a minute and send some positive thoughts, some prayers out to those in Los Angeles. A lot is happening up there, and there's a lot of people affected. And I just want to send them some positive thoughts. So chances are, if you know anybody in LA, you know somebody that's affected at this point. So it's a big thing. So
that's the most important part. Secondarily, Kawhi Leonard, I understand his house burned down. I'm sure we're going to have lots of other celebrities and athletes just because it's a very nice area of high-end homes. But for any of you in Los Angeles in escrow right now, know that this will likely delay your closing. Lenders don't want to lend when they don't know the status of a home. And probably the craziest example I had about 6 or 7 years ago, we were supposed to close 2 days before Thanksgiving. My borrower was in Long Beach, or their house was in Long Beach, about 2 blocks from the beach. The fires were up in Big Bear. It came into LA County. So FEMA had LA County on their map as a disaster area. So we couldn't close until they ended the disaster. And we took pictures to show that the house 35 miles away from the fires weren't impacted. So if you hear something crazy from your lender, just know they're going to act out of an abundance of caution. They're probably following FEMA guidelines that are going to cover a much broader area than where your home is actually located.
All right. And the title of this episode is These Challenges Will Have a Huge Impact on the 2025 Housing Market. One of those things is insurance, right? That is one of the things we were meant to talk about before all the fires actually broke out. The other thing that's affecting the housing market or has an impact on housing market is inventory. One is rates. All of these things we're going to discuss tonight, as we always do. But do us a favor as we start diving into tonight's episode. Start putting your questions in the chat. It's a lot easier to come out of charts and start diving right into your questions. Makes the episode flow a little bit faster and better for you guys. And also let us know where you're watching from. That's always helpful, knowing where our viewers are currently sitting. So with that said, Josh, we always like to take a look at inventory in order to start the week. And that's one thing we're going to do today. So inventory continued to fall over the last week. 650,000 homes down to 635,000 homes. Still have 27% more inventory than we had the same week last year. But something to note here, inventory fell in a holiday week. So this data is about a week old. So nothing really to report here, nothing really to concern yourself with. You'll notice when we start looking at Orange County and Huntington Beach charts, which we're going to here in a minute, inventory actually ticked up, which is a positive sign for those looking for more homes. And we'll kind of discuss that here in just a minute. But as I mentioned a moment ago, we went from 659.92 down to 635.432. Our peak last year was at 739,000 homes, and our low again was back in 2022 at 240,000. Context looking same week, I think about 2015, looking at about 959,000 homes compared to where we are today. And you'll kind of see this in some additional charts that I put up. So this came from Resi Club. It's the same chart as the first one, just showing inventory, but it also threw in 2018 and 2017. And I like that because it just gives you a little bit more context as to where inventory is historically speaking. So you kind of get an idea there.
Jeb, did you see in that same article? I don't have it up in front of me, obviously, but Lance was talking about it would be if we stay on the current pace, it was a year and a half, 2 years, you would get back to those 2018 levels.
Yeah, exactly. And so this shows our shift over 1 year from December of 2023 to December of 2024. So you could see the majority of the United States there up double digits when it comes to inventory. And you think, well, all problems are solved. Well, then you look at December of 24 compared to December of 2019, and you see that the majority of states out there still well below. I think at the moment, 9 states are above where they were in 2019. We were up to 10, 11. We were headed towards, I think, 14, and now we're back down to 9. So because inventory's fallen in some of these states, we're still not back to those 2019 levels. It's only happening in 9 states. So Orange County, as I mentioned, up almost 9% week over week. This is kind of a rare thing. We usually don't see inventory start to pick up for the next couple of weeks. In fact, the last year, we didn't see inventory trickle up until, or actually bottom out until April, May. You can kind of see it on these charts here. When we look at Huntington Beach and last year, like we weren't bottoming out until late in the spring. So is this an early sign of inventory to come, or is it just an anomaly? Hard to say at the moment, but we are getting that increase, and you can see Huntington Beach up almost 19%. So down last week about 18%. This week up about 18%. So we're sitting at 182 active homes on the market. And then new listings. So new listings, only 18,484. And again, they basically attribute it to the holidays. So again, nothing really to pay too much attention to here, just because it has some of that holiday built into it. Total contracts pending. Let's see. New contracts were low. Again, based on the holiday. Total number of home sales in process stands at about 260,000, which is 5% higher than the same time last year. December's new contracts showed no growth compared to 2023. So, more or less the same type of market. And we saw a lot of what we saw in 2023, which is higher rates. Although 2023, we saw rates kind of move lower as into the new year. This year, we saw rates move higher, but more contracts pending. So price reductions, just under 35%. Again, nothing really to concern yourself with there. And I threw this in here, Josh, because everybody's talking about the number of transactions expected to close, right? So this year we were around 4 million homes that closed in 2024. We don't have the final numbers yet, but that's essentially where it's going to end up based on most people's predictions. If you took the average here, it's at 4.22. So not much better than what we saw in 2024. But the idea here is that rates are going to improve, which is in turn is going to lead to more transactions. I thought it was just an interesting take because you kind of have a wide range of where people are thinking home sales are going to be, but for the majority, it's still low. So
the ones on the low end are like bonkers, because you would have to go back so far in time. We're already at like 1996 levels. So is it just amazing that it hasn't happened in 30 or 40 years? No, it's the population has grown so much since that time. So the per capita sales would be so low if you were under 4 million. Like, just with the natural stuff, the things we talk about, death, divorce, life events, there will be about 4 million homes sell a year. I would be shocked if we got below 4. But we talk about it all the time. It comes back to affordability. The only thing that moves affordability largely by a significant amount in the short run is interest rates. So interest rates are going to tell the story with what happens.
They definitely are. And we're going to be talking about those more. Our debt, Josh, it keeps climbing. How do we stop this?
Well, look at that. We've looked at this a million times. This is just a look from 2023, 12 of 23 to 12 of 24, $2.22 trillion in 1 year. So we owe 36 trillion. By 2030, we are looking at like 50 trillion. So why do we care in the context of a housing and mortgage and real estate show? From that perspective, this is one of the things that over the long haul has shown to not have an impact in increasing bond yields. But there are periods of time where you absolutely see big fears in the market, because what it means is the way this gets financed is they go and they issue more treasuries, short-term, mid-term, long-term treasuries, and there's a fixed amount of demand for that. So when the supply increases, the prices paid go down and yields go up, and that's what we are seeing. The reason why the yields go up, people are saying, "Well, geez, you're getting in trouble." Just like if you start maxing out your credit cards and your score goes from 800 to 600, you start paying a higher interest rate on it. There's a lot of those factors at play. So this is also going to impact. We've got people on the left, we got people on the right, we have sane middle of the ground people that watch the show, and everyone has a perspective about what the new presidency, this red wave, is going to do for policy. You saw in the election of the Speaker of the House that there is not a monster majority there, and there is a not so silent minority in the House that is just tired of this right here. And it will impact how much of Trump's agenda gets actually enacted, because there is some more deficit spending if he were to do everything that he wanted to do. Jeb, we talked last week. The big thing this week is jobs. So yesterday, the first one was JOLTS, Job Openings and Labor Turnover Survey. So this is the second or the third month in a row, Jeb, we've seen more job openings. So again, for you guys watching at home, why do we not want more job openings? Or why does the Fed not want more job openings? It means we have a finite amount of workers, and so demand for jobs, and we're increasing the supply. So the only way you're going to get them is you're going to have to go and pay more for them. So that's the worry. But what does not make sense about this report is we see hiring is going down, people quitting their jobs is going down, and the layoffs are going down. So employers are not hiring people, but we have more job openings. They're not laying people off, but we have more job openings, and people are not quitting, which generally tells you that they do not feel super positive about finding another job if they were to give up on the one that they have currently. So something for everyone in that report. If you think this is inflationary and bad, you see it. If you think it's a disinflationary trend, you can see that as well. Today, Jeb, we got ADP. The numbers here, you can see we're at low levels, under 200,000. So we're not contracting, we're not losing jobs, but we're not creating a huge amount of jobs. So the 3-month average is now 151,000 jobs a month per ADP. The 6-month average is 138, and the 12-month average is 152. Last year, or the prior year, prior to 2024, that average was 209,000. So the trend is absolutely for this to be cooling, but it's not contracting where you're seeing massive spikes in unemployment. Thought this was interesting, Jeb. Here is a chart of government bonds, 30-year government bonds in China and Japan. For the first time, you are seeing Chinese yields go and move under Japanese yields. And someone said this was the first time in history. The chart only goes back to 2010, so I don't know what the history of bonds there is, but it tells us a couple interesting things. The Japanese economy is doing better. So to keep things under control there, their Fed is likely to continue raising rates throughout the year. And why do we care about that in the US? Some of the investment, both in equities and treasuries in the US, has been this yen carry trade. When yields or rates are really, really low in Japan, you can borrow at low rates, invest in another country that has higher rates, higher returns, and make money off of that. You have less of an incentive or less of a tailwind there. So if that continues, that will be possibly problematic for bonds and interest rates. From the China side, it tells us the opposite. This is the lowest their yields have been in a long, long, long time. So they are the biggest exporter of goods around the world. So that is a disinflationary tailwind. So if they are trying to prop up their economy, they're going to try and be more competitive. They're going to try and cut prices and export their disinflation around the world. So again, thought it was an interesting chart. What are we looking at now? This is an interesting chart, Jeb. We are down to the next 3 Fed meetings. The market is saying we're likely to not see cuts, but it's really what, almost 50-50, 50, 42, and then 8, we'll say a 50 basis point cut in May. That would be interesting if they lay out for the first 2 meetings and then come in with a 50 basis point cut. But the majority here see rates only getting 1 cut this year. And what, at one point, Jeb, were we like 6 or 7, the bond market had, or the futures market had priced in? So that's an interesting look at it. I think we overshot it when they were expecting 6 or 7. I think we're overshooting it when we're only expecting 1. Fed Governor Waller gave a speech to the OECD in Paris today. Some interesting comments in there. He's a voting member this year. This minimal further progress on inflation has led to calls to slow or stop reducing the policy rate. However, I believe that inflation will continue to make progress towards our 2% goal over the medium term, and that further reductions will be appropriate. Kind of the details, this isn't a direct quote, but if you paraphrase what he was talking about, he's saying the inflation in 2024 was largely driven by increases in imputed prices. What the hell are imputed prices? Things like housing and non-market services, which are estimated rather than directly observed. And he considers a less reliable guide of the balance of supply and demand across goods and services in the economy. So he's one of the more dovish members of the Fed, but he still believes that we are seeing disinflation and we'll see progress towards that 2%. Now, I'm giving you Jeb's wonderful chart here because he likes to put 9 million lines on his. Why don't you walk us through this, Jeb?
Well, I can't see it, Josh, because of the way my screen's set up. I mean, essentially,
you sent it to me this morning. You know what it says.
Well, I don't know what the actual numbers are. I mean, essentially, you've broken out of the top of the channel, right? And as of today, you hit resistance on kind of an upward wedge forming, and the line down from the peak that we saw back when bonds were at 5%. So you're kind of at this inflection point, I think, in where bonds are. I mean, if you break out of the top of these support areas, if you will, you're headed more or less back to well, 4.7, I think, is like the next little hiccup, which I didn't draw in there. There's a gap down. If it fills that gap,
4.73 was where I saw another bond company.
yeah, and then essentially, if it fills that gap, it's probably going up to 5%. And there's a comment in tonight's comments that basically says, if I'll start getting worried if bonds get back to 5%. Well, I think there's a high likelihood based on this chart that you could see it. You need really positive news to come out Friday with jobs.
You mean you need really negative news?
Well, yeah, I mean, yes, you need negative news, positive for interest rates, with jobs essentially plummeting. You need negative jobs on Friday in order to see this go the other way.
So I'm going to counteract Debbie Downer here, just so you know. Neither
Debbie Downer. I'm optimistic. Well, the chart doesn't show it.
Neither Jeb nor myself are pessimists, but when we look at this, he is more of a glass half empty. But he is dead right. 473 needs to hold. If 473 doesn't hold, we're likely moving to 5, and 5 absolutely needs to hold. So Jeb, I woke up this morning again. Pessimist Jeb sends me this the first thing in the morning at like 5 a.m. Take a look at this wonderful article I found. So Amundi's bond chief says U.S. 10-year yield can exceed 5% again. He said that is not his base case, 25 to 30% chance. But there were several other comments. There was a Chase analyst in there, and most of them saying, we don't think it's going to happen, but there is a not insignificant chance that it could. But they all said, as large institutional investors, that they would see it as a buying opportunity meaning to buy treasuries, which would push yields back lower. So big picture, you would like to think we are somewhere within 0.25% of the peak, which also, Jeb, that kind of coincides with most of the people that gave a range this year of that 5.75 to 7.25. We're close to 7.25. This one, Malden threw this in his weekly charts that matter, Jeb, and this shows the 10-year treasury yield and U.S. GDP. So if you look at the part that's kind of ghosted out there, we generally see when the 10-year goes down, GDP goes down with it. When GDP is going up, that's positive for the economy, but there's a lot of money floating around and yields go higher. So what we've seen since the lows in COVID, GDP spiked and now it's crashing. It's still at trend. GDP is not bad. It's at trend there, but the 10-year has gone up through that time. So I don't expect that to continue to happen. At some point, you will see a normal relationship. So either 10-year yields are going to come down, or you're going to see GDP go up, because that relationship will prove correct over time. Through this one in here, Jeb, I do the spreads using Optimal Blues index versus the Freddie Mac Primary Mortgage Market Survey. We still continue to see these spreads coming down. We talk about the spreads, the 30-year interest rate that most well-qualified borrowers are seeing versus the 10-year treasury. We're still way above normal at like 2.25, 2.3, somewhere in that range. But the trend is coming down. And if mortgage lenders felt like rates were going to stay higher for longer or going to trend higher, that would not be the case. You wouldn't see the spreads narrowing. So where are we at? 7.17. I think we're at 7.12, 7.13 last week, Jeb. Mid sixes on FHA and VA. And as always, these are national averages. They could include some amount of points. So most well-qualified borrowers working with a good broker are going to get a little bit better than that.
All right, good stuff. This slide's always up there. If you're currently in a loan looking to refinance, got a rate a little bit higher than you want, or just want to take advantage of a lower rate as it comes available, scan this or go to jebsmith.net/rate watch. Get on the rate watch list as rates come down. Our team will reach out to you, and that way you don't just have to sit here and watch rates every single day. And with that, Josh, I think it's we didn't put a slide in here, but I'm going to mention it. We can do something as one is talking and actually build what the website is. But Josh and I are doing a home buying webinar. So webinar, it's online, it's free, it's an hour. It's going to be on January the 28th, which is a Tuesday. It's going to be at 5 p.m. Pacific Standard Time, 1 hour. This isn't fluff. This isn't us just BSing around for an hour. It's literally giving you everything you need to know to buy a home in one setting. I have all the videos out there. If you don't want to do it, you can just watch random videos and figure it all out. This is an easier way to do it. So if you want to register for that, head over to jebsmith.net/seminar. I should have made it webinar. It's seminar. jebsmith.net/seminar, and get on that list. Obviously, you'll get the link as it becomes available, and confirmation that you're in, and we'll update you, and we'll go from there. But that's all it is. It's not a salesy thing. It is literally there to educate, inform. It's one of our goals of 2025.
And really, Jeb, I'd like to say, who is it for? It's for anyone thinking that they want to buy a home this year or in the future.
Yes.
It's not to talk you into buying. It's for someone who thinks they want to do this, to educate you as to why and how to most effectively purchase your first or next home.
Very good. So with that, guys, jebsmith.net/seminar. Okay, so we've got a couple of comments here that I want to throw in there. There's a couple people that made some good comments. Sam's basically saying, will this result in insurance issues like Florida? That's not a comment. That's obviously a question. But someone came in, followed that, and basically said, yes. I mean, you're going to see insurance companies do what they've done in Florida and up premiums because of things that are happening, natural disasters, wildfires, that sort of thing in LA. And the reality is, yes, it's probably coming. Now, the difference in California and versus some of these other states is California limits how much some of these insurance companies can actually increase premiums. I don't know if Florida does that. So that's what caused a lot of these companies to leave the state of California, is that they were losing money, and California said, you can't increase the premium more than X amount. And so people were like, well, we're not going to lose money, so we're out. So I'm assuming California is going to have to do something here to allow these insurance companies to do a little bit more. So we'll see. With that, I also saw a comment, Josh, from some friends of mine who live in LA, real estate agents. I use the term friend loosely, but they're agents in LA, and I know them, and they posted something. They're in Pacific Palisades. They lost their house. And one of the things that they mentioned, I don't know who it was, but somebody had cut funding for the fire thing by like $17 million, like 60 days ago, like something.
Makes sense. Logical.
Yeah, great move. But I'm assuming that's probably going to come back to bite.
We haven't had any problems with fires recently, so I could see them getting lulled to sleep.
Yeah, just it's gone. Okay, let's see. What do we have? Josh, we have some comments here. Let's do this one. Willing said, what's the difference between fixed and variable cost? If a contract has allowances, does that mean it's a variable cost contract, Josh?
Allowances, what do we mean allowances? Just credits, where they're giving you credits? It doesn't make it variable. The cost of the home is always going to be fixed in the contract. So if someone says we're giving you 2%, we just got to figure out what the percentage of that is of the purchase price. So just need some clarity, Willing, on you're usually so spectacularly clear with your very poetic question. So maybe clarify, and we'll circle back.
All right, good stuff. Alvin basically came in and said he watched. He's been watching Bigger Pockets for 4 years. Saw me on there with Dave on one of their branch off shows On the Market, and just asked how I got on it. They actually reached out to me to be on there, so I did. It was fun. It was a good time talking to Dave, and what we talked about was actually fun because we got to talk crap on other YouTubers' videos that were basically spreading false information. So if you haven't gone and checked it out, it was probably about a month ago that it came out, and we picked some of your favorite YouTubers and talk about why they're wrong. So it's worth checking out. I think it's a good video. All right, Josh, we don't have a lot of real like questions like we normally do. Let's see. Here we go. Are there any tax preparation professionals in San Diego area that you recommend? We recently got married, bought, and sold property. So Josh and I both use someone up here in Orange County. Do you need somebody local? I don't know. You probably want to go in and have a conversation. I don't personally know of anyone in San Diego. If you want to send me an email, I'm happy to do a little bit of research for you, ask some people that I know down in the area and see if they know of anyone. But I
Jeb,
don't have anyone.
you'll
Yes.
find this interesting. I also have a tax professional in San Diego because Kevin, our guy, something with his licensing as an enrolled agent, he will not do returns for disregarded entities, such as a self-directed IRA. So I've got a group down in San Diego that does the return for my SD IRA.
There you go. So if you send ourselves or Josh an email, there you can use any of those emails in the description of the video. We'll definitely reach out to you and give you that information, pass the referral along, if you will. Josh, what do we got here? Are we just
Well, Chris wants to know if any ideas, new ideas on where mortgage rates will go this year with jobs data from yesterday. Maybe 8%. Highly unlikely. I do not believe 8%. Even if you have a 5% treasury with a 2.3, 2.4 spread, it puts you at 7.5. Would
Yeah.
some people be there if you're buying an investment property? If you got a 600 credit score, yeah, some people would be there. But that is very likely to be the high end of the range for the year.
One of the biggest things that have changed since rates were at 8% 2 years ago is the spreads have improved considerably. Still not where they need to be, probably 0.75% off, but still better. So, I mean, if spreads were where they were back then, we would have interest rates close to 8% now. We wouldn't be that far off. So fortunately, spreads have improved. So you would need the either spreads to get worse or the 10-year to go higher than 5% to see 8% rates again. Neither of which I'm hoping we see. So, time
neither
will
of
tell.
which is likely. Like even the fringe people out there, I know a number of people who think 5% is in play, and even some that think it's likely to happen. Peter Bookvar has been saying for a year and a half, we're going to see 5% again before we see improvement. I don't know of any reputable trend followers that think that we're shooting above 5%.
I'm sure there's some doom and gloomers out there that we'll hear from as soon as it happens. So that they've been on it all along. But nevertheless, we got Steve trying to purchase a $400,000 rental property, but DTI is too high. So any suggestions on that? So Josh, when it comes to a rental property, you have a couple of things, right? You have the rents that the property's producing that you can use. And you have your income and your debt, I guess, and your down payment. So how do you skin that cat?
Debt service coverage ratio loan. So any investment property, you're going to be looking at a higher interest rate and a bigger down payment. So if you're looking at 20, 25, 30% down payment, the DSCR loan comes into play. So high credit scores, if the property generates a decent rent yield, it's not going to be a huge premium. The spreads between a DSCR and a full doc loan is not extreme right now. I mean, the numbers are what they are, assuming you're working with a good mortgage professional that knows how to analyze the numbers and wring every last dollar out of it. The part that's not in your control or the loan officer's control is the market rent survey. If you're buying the property or refinancing, I mean, refinancing where we're going to look back at the last 2 years tax returns for what you've netted on rent there. But if it's purchased, we're going to need a market rent survey to confirm what those are. And they're almost always conservative, much lower than what you're actually going to be able to get for the property. So the only real easy button there is a DSCR loan where they're using the rents to qualify versus your income.
Okay. Robert made a comment here that mortgage rates, if mortgage rates drop under 5%, it's because we are in a recession, which will hurt housing even more. Either way, housing prices will face a correction. So I disagree with the statement. I agree with the first part of the statement that the only way we're going to see rates under 5% is some sort of recession, some sort of some sort of economic issue, right? That's causing, the Fed to have to stimulate the economy with lower rates. So that's why we'd probably see lower rates. Would it hurt housing even more? It all depends, right? It depends on where inventory in demand is at that time. We've seen back in September when interest rates went from mid sixes down to the low sixes. What happened? Purchase applications jump, pending home sales jump, buyer demand. All of those things that are tied to that is all due to buyer demand jumping, right? That's because there's people sitting on the sidelines waiting to buy housing. What we've seen is, I think, I forget which index it was, CoreLogic or one of them. It was like last year, price appreciation, Josh, was 3.6% year over year, right? Roughly 4%. We'll call it 4%. Everybody's talking about this correction. The correction is prices stabilizing more so than anything else. We haven't seen a correction in the majority of markets out there. Texas, Florida, some of those, yes, there's been a correction, but that is not the entire United States. That's a couple of metros in the United States. But Josh, what are your thoughts on it?
Yeah, it's just a failure to understand the mechanisms underlying there. So he had a comment previously that housing is going to crash. The only way you get a crash, every time we've had a crash, first of all, we've ever had one nationwide. So we talk about all real estate is local. You can have one in a market while the rest of the country is doing great. But nationally, a home price crash has happened exactly one time, and that was due to horrific lending standards, low loan to value, low credit scores, variable rate loans, a million different reasons there. So when we look at it, every time we've seen locally in any market, you have a large percentage of bank-owned properties. So we do not have a recipe for bank-owned properties. Is it 36, 37% of homes are owned free and clear, Jeb?
It's higher than that. It's 40%.
40%. So 60% of homes have them, or 40% couldn't get foreclosed on. 60% have the average loan to value is under 60%, and the average interest rate is under 5% on 70% of those. So when you look at it, the cost of ownership for all of those people, does that mean that everyone is insulated from having any trouble and no one will ever lose a property? No, absolutely not. But you don't need a small amount of foreclosures. You need a wave of foreclosures to see a crash. So there's some truth kind of in the logic of what he's thinking there. To me, there's kind of a floor under the market and there's a cap under the market. If rates come down, there's enough people. And like, if you're a cop, this is just an example. If you're a cop and the economy tanks and rates go to 4% and home prices drop 5%, you've been waiting to buy, you're going to go, this is sweet. I'm not losing my job. I'm a government employee, and there's a million different types of government employees. So there is a base of people that will come in and put a floor under the market. It's not a recipe for super high inflation. If you have a recession, that would slow things down and take rates that low. But then even to the high side, if rates go to 8%, people go, oh yeah, the market's gonna crash. I mean, go to 8% and stay there persistently for a period of time. What happens then? You have even more lock-in. People just go, no way. I was considering it at 6.5. I was considering it at 7.25. At 8, I pry this house out of my cold dead hands. So we've talked about this. Another way this corrects going forward, or affordability comes back in line, is that prices in Realtor nominal terms stay level or very low appreciation over a number of years, while wages increase slowly over time, and while you see interest rates normalize back to another level. So I don't think we have a recipe for a big amount of appreciation, but we absolutely don't have a recipe for a crash.
Good stuff. Let's see. Hav says buyers pay for closing costs, ? Normally sellers pay commission for both parties, correct? I'm assuming that's what sellers mean, and sellers pay commission for both parties. So typically buyers pay their own closing costs. So there are some of the closing costs that the seller pays in a buyer's transaction. Usually they pay the lender's title policy. They split escrow 50-50, depending on where you're located. You may or may not have that. They pay for some of the things, home warranty and some of the other things. Typically, not always, but you can get concessions for those things. You can get credits for those things. There are ways around the buyer having to pay directly out of pocket. That said, sellers pay both parties commission. That is the way that it was up until August of last year, something like that. Typically what happens now is the seller's compensation, or the listing agent's compensation, is paid by the seller. The buyer's agent compensation is negotiated through the contract. So you have to come to an agreement with your agent what you're willing to pay them. And then it's up to you and your agent to figure out how that gets paid. You either pay it out of pocket, it gets paid because the seller's offering you some sort of concession, some sort of credit, or it's built into the price. There's multiple ways to do it, but it's not as straightforward as it once was. Your general logic is correct, but there are a lot of different nuances that can change both of those. So just make sure you're working with a professional that can guide you through that process and answer those questions for you. Josh, question here. We get a lot. How strict are lenders when renting your primary home before 1 year? He asked conventional lenders. I'm just going to say it doesn't matter if it's conventional, FHA, whatever. It's pretty much the same. So
no one is checking. The
Fair.
only way this comes up and becomes an issue is like if you want to if you buy a home 2 days later, 2 months later, 12 months later, you want to convert it to a rental. The only way that anyone's going to ask about it is if you're trying to get another mortgage and go buy another primary residence. They're going to look. There's a system called MERS, where Mortgage Electronic Registration System, where your deed of trust, your note has that MERS number on there, and they can look this up and they go, hey, that dude Jay bought a house 3 months ago, owner occupied. How is he buying this one owner occupied? He either lied to them or he lied to us. But no one has a list and goes, hey, here's all the people that bought 3 months ago. We got to go out and knock on the door and see if they're there. So in 29 years of doing this, I have never seen anyone get in trouble for it. I have seen situations where someone had a very good excuse, rationale, reason for doing an owner occupied loan and needing to do another one 3, 4, 5 months later, or where the occupancy on the new home is in question. Hey, that doesn't make sense. It's 2 hours from your work. Are you really going to commute? I have seen a condition where a lender puts in there and says, hey, we're going to do an occupancy inspection in 60 days, 90 days, 180 days, and you better still be in there. But very, very, very incredibly rare.
All right. There was another question, or kind of a comment and a follow-up question. Fed Bar is stepping down, although he said originally he would not if pressured. Do you think Jerome Powell will resign as well, leading the way to 3% again, even if the market does not reflect need? I do not think that Powell is going to step down, based on what he has said so far and how he's been through, just in general, commenting at different meetings and and after press conferences and that sort of thing. I mean, remember, Trump put him in office back in 2016, I think, and 2016, 2017. He got a lot of trash talked about him by Trump during Trump's presidency. He didn't resign then. He's only got a couple of years left. Chances are he's probably going to stick it out, in my opinion. And I think he has sort of this path that he wants to go, and I think he wants to complete it. I think he wants to see it through just based on how he's mentioned certain things. So I think he's going to be here to stay. And, and again, in order to see 3% again, you got to see a really shitty economy. I mean, right now. And I don't think you're going to see that. Not in 2025. A lot would need to happen to see 3% rates again. Josh, there's a long one here. I'm trying to piece it all together, so I'm going to do my best. It says new construction. If private inspection, some issues were found with the house, electrical, plumbing, etc., and the house is due to settle a week after the inspection, can one request to pull out?
Not pull out, push out.
Push out. Well,
push out the closing, not back out of the transaction, push out the closing.
Push out the closing. And then go. So we'll get that one. Then second part of that is after settlement closing, when will the official mortgage payment be, assuming settlement date is 1/24? So we'll answer that. And then thirdly, if you lock in a mortgage rate at 5 1/8 with a builder's lender and you find out a month later that they have a new rate of 4.99, when can you take advantage of that? So let's start with the first part. New construction. So if you do an inspection, issues are found a week before closing, it's up to you to whether or not you close or not. What's going to happen, typically speaking, is the builder's probably going to try to get people to take care of it pretty much immediately. Some things they like to try to push to after close. They want to get it closed. They say they'll do it. As a buyer, you don't have to agree to that. Each builder is going to be different. They're probably going to push a little bit differently. Hopefully you have an agent that can represent you and kind of get in there and help push them back, assuming you're not just working with the builder directly. If you are, stand your ground. Tell them you want it resolved before closing. Most of them will cooperate because they want to get that thing closed. So that's how that is. If it's not done, can you push it out? In theory, yes. As long as you're communicating, doing what you're supposed to do, and everybody's working together, you shouldn't have an issue. But again, you have an agent, let them do their thing and pressure the builder to make it happen. Josh, if somebody closes in January on the 24th of January, when would their first mortgage payment typically be due?
would be the first of the following month. And the reason being, you close on the 24th, there's 7 days left in January. You will owe that interest, but the lender doesn't want a 7/30th payment on the first of the month. They want 360 or 180 or 240 full monthly payments. So at time of closing, you'll pay prepaid interest in the amount of the number of days remaining in the month. So now we hit the first of the following month, you accrue 30 full days, and the first of the following month is when your first payment is due. So if you closed on January 24th, no February 1 payment, March 1 would be your first full payment after your first full month with the loan.
Yeah, I mean, the way I always told people is that you pay your interest in arrears. So when you make your March payment, for example, because that's when your first payment would be due March 1st, you're actually paying the interest from February. And so what happens is when you close, you pay that interest through the end of January, and then you're skipping that month in theory. You're not really skipping it, but because you are paying it at some point, but then you're paying that payment through your March payment. So hopefully that makes sense. And lastly, Josh, if somebody locks their rate and then finds out there's a better rate down the road, what happens?
He who holds the gold makes the rules. So if they're nice and they have a policy, or you ask nicely and they want to give it to you, great. But those are bullshit interest rates. They don't exist. The builder is eating it to offer that to you. So they are likely to say, I'm giving you a wonderful interest rate, and you're telling me you want a better interest rate because I offered that to people coming behind you. And remembering you've got a 125-page builder contract that locks you in 6 ways to Sunday. They don't have to do anything. They might, but they certainly don't have to. This isn't something where you can go to the lender across the street and go, hey, can you get me the 499 they're offering, because they're subsidizing it.
All right. Sam made a comment earlier, and we're going to follow it up here. Basically just says that he owns 100% equity. And so basically he owns a house free and clear in the northeastern part of the United States. Should he wait for lower interest rates before selling? Everything seems so volatile right now. Hard to say, like, what's the goal of selling, right? Is it to buy something else? Is it to move out of state? Is it to sell and you already have another property and you don't need the funds from it? There's a lot that goes into it. And the reason I say that is because if you're selling something now and buying something at the same time, it's a wash either way. However you look at it, it's essentially the same thing. If you are in a market that has very little inventory at the moment, which I think a lot of the Northeast does, there might not be a point to waiting, right? You might have a strong market now just based on where things are. Now, rates are obviously an issue for a lot of people, but there's a lot of cash out there. So you need to talk to an agent and kind of figure that piece out. But if you're in a market that has a ton of inventory, or things just don't move this time of year because there's snow on the ground and it's just a slow market, typically speaking, then you got to weigh that out and make that part of your decision. But I don't know that I would wait for lower rates. I don't know that lower rates are the answer for selling the house. I mean, could it be? Possibly, but you got to understand, like, what happens between now and when rates get to that point. I mean, does more inventory come to the market? Do prices stabilize in your market? Does more inventory come to the market and push prices? There's a lot of different things, and you only know what you know right now. And so predicting a lot of these unknown things in order to make a decision is very difficult. You got to, take what you can and move forward when it makes sense for you. So if it doesn't make sense now because of something, then wait. And if it does make sense and you're just trying to get more, then that's called greed. And that usually ends up affecting you in another way. So
Greed is good. I heard that in a movie.
you did. Yes, you did. So I don't know if I answered your question there, but hopefully that provided at least a little bit of context for you. Drew bought a house in New York last year, listening to our advice, and is thanking us. So thank you, Drew, for watching and listening and being a part of the show and all of that. And yes, I hope rates go down as well so that you can take advantage of them. I keep talking the questions, Josh, and for whatever reason, and I'm not clicking on the actual question. So, Josh, if you have a perfect credit score today, perfect, just the best score on the entire planet, what interest rate would you get for a VA loan?
Depends on what you want to do. 0 points. We showed at the beginning of the show, the national average with Mortgage News Daily is about 6.5. You're probably looking 6.25 with 0 points. If you want to pay a point, it's going to get it under that 6% range. Unless you want to pay a ton, you're not going to get much lower than about 5.75.
Good. Carson asks, is there a good time to buy from a national builder? D.R. Horton has been cutting prices with a lot of inventory in my suburb of Nashville. A first-time home buyer, love the show. So thanks for listening, Carson. Is there a good time to buy? Again, Nashville
is now a good time. You're looking at your little tiny monitor up there. Is now a good time to buy?
Is now a good time to buy? It depends. I mean, again, it's how much inventory there? Are they trying to unload it? Are they doing incentives that they weren't doing prior? I mean, all of those things got to factor into your position. If you plan on holding that home 5, 7, 10 years, you're probably fine. I mean, there's no reason that, waiting is necessarily going to benefit you. If it's earlier in the phase of that construction project, that could benefit you as they sell more homes in there. You kind of reap the reward of that. If you're towards the tail end of that and they have a inventory, try to negotiate and work on deals. I know Nashville is one of those markets that's seen a slowdown. Inventory has built because there has been a lot of construction. It's hard to say. I think if rates come down, you're going to have more competition, especially on new construction in those markets, and which would mean prices stabilize even more. If they have builders don't want to hold on to property, right? They either need to move on to the next project or they're looking to get stuff sold for one reason or another. So typically speaking, if they have inventory, now is a good time to take advantage of it. And a lot of them will offer you incentives to buy down the rate, which in turn could impact you in a much more meaningful way when it comes to the bottom line, which is price for most people or payment for most people. If price is your thing, then you can negotiate that in a different way. Josh, let's see. What do we got? What is the DTI limit on an FHA loan, Josh?
So there's two different things. There is what the FHA total scorecard will allow in their automated underwriting, and then there's what is in the manual guidelines. For 80-90% of people, you're going with an automated underwriting. So again, it's per the AUS findings. The absolute maximum, which probably 75% of borrowers can go to, is a 46.99 housing ratio, so call it 47%, and 56.99 total debt to income ratio. So your housing payment can't be any more than 47% of your gross income. And when you add in all your other debts that show up on your credit report, auto loans, student loans, credit cards, installment loans, any of that stuff, it's got to be under 57%.
There you go. On top of the housing expense, not separate, guys. Saw a video yesterday that explained the debt to income ratio incorrectly. So just make sure your back end of your debt to income ratio also includes those same housing expenses that are on the front end ratio. Just a heads up. Let's see.
Let's close the loop on that, Jeb. So if you go to 47% and the max is 57, you can only have 10% of your gross income for all your other debts.
There you
if
go.
Someone else is buying with a 20% debt to income ratio, they could have a Maserati, they could have a condo in Boca, they could have all sorts of things in other debt. So it's sort of a sliding scale. The less other debt you have, the lower your debt to income is going to need to be.
There you go. Good mention there. Let's see, Josh.
Wheeling came back with one here. Says, would it ever make sense for someone with high LTV to refinance a year later while they still have high LTV? Absolutely. It doesn't matter. If you have a 7% interest rate with 0.7 mortgage insurance and you can refinance it to 6% with 0.7% mortgage insurance, you would still do that. It's just a factor that goes into play. This last round, we were lucky. A lot of people were able to go to the next lower debt to end or loan to value tier and get slightly lower mortgage insurance or get rid of it entirely. But really, you're just looking at the monthly savings is what matters.
Excuse me. Does FHA require that the spouse's credit be used as well?
Trick question, Steve. Are you in a community property state or not? So in California, other community property states, they do. They can have terrible credit. They could have a 300 credit score, but we're going to have to pull their credit and we're going to have to count all their debts against them. And generally, when that non-borrowing spouse has terrible credit, it's because there are collections. So if there's a large amount of collections, we have to count 5% of those balances as payments. So they may not be making payments. They could have $50,000 of collections. Nope, don't owe anybody anything. It's all in collections. Charge-offs we can ignore. Collections we have to come up with a fabricated payment to count against you.
Good stuff. That's actually, I don't know that we've ever had that question. So good question. Clip News says, to the point you made earlier on payment starting 30 days after settlement, can a buyer request you push it out one more month? So Josh, if you close in their example, January 24th, and you don't want your payment to start on March 1st, you want it to start on April 1st, can you do that?
So remember, there's a little misunderstanding here that it says the point you made earlier on payment starting 30 days after settlement. That is not what we said. It starts the month after the first of the month after closing. So you close on the 24th, the first of the month is the first. 30 days after that, the beginning of the next month. So no, there's no free rides. You have to make your payment. So every lender looks at it the same way. If you close on the 10th of the month, you're going to pay 20 days of prepaid interest and you're going to have 50 days till the next payment. Whereas in that scenario, we're talking 7 days prepaid interest and 37 days until your next payment. But it's not at anyone's discretion. The lender is loaning you hundreds of thousands to millions of dollars. They want interest on it for every day that you have it.
No, I think he's asking though, can you, instead of having a March 1st payment, can you change when your first payment is actually due?
He's saying, can you request to push it out one more month? Could you go more than 30 days?
Well, that's essentially what I'm thinking, like the way I wrote the question. So could he, if he closed in January, could he have an April 1st payment? Is the way I'm asking the question.
That's what I'm saying. No, it is the first of the month, because if they did, the lender's not saying, hey, we like Clip News, we're going to give them 30 days free interest, 30 days free use of our $500,000. They don't. So if they were going to do that and say, okay, cool, we'll do that, give us 37 days of prepaid interest at closing. So there's no free ride. You're not
exactly
away from getting around it.
It can be done. You can have an April 1st payment, but you're essentially building that payment into your
How would you have an April 1 first payment if you're closing in January?
I thought you, on like a refinance, I thought you could capture the interest in the loan, and
you would have to close into the month. So you're not making your payment. So on a refi, you would have to close in January, not make your January payment. Then you're not having one due for February. So you're going to collect again. Again, no free ride. All of that.
No, it's not a free ride. It has to be paid, but just the date could be altered in a way. I don't know.
That's
anyway.
You're right. So I'm thinking in terms of that purchase scenario we were talking about. You are right. So if you have a refinance, it can be done. But instead of 7 days of prepaid interest, you're going to have like 37
days. You're paying it. You're
just
just paying it in a different way. Yes, exactly. You're not paying the principal. You're just paying the interest. So might end up a little less expensive, but at the end of the day, it's all the same thing.
Jeb, we don't even need the audience. We can just sit here and debate arcane points about when interest.
Oh, that's great. Let's see here. Did we answer all the questions? Well, I think we probably pushed everyone away once we
started talking about when interest is due and prepaid interest and fun things.
Yeah, nevertheless. Let's see here. I think we're done. Show's over. No, earlier somebody mentioned that the background being purple or whatever changed. So Jeb thought it was a good idea to change his background because it's been the same for about 2 years. So thought I would change it, and then I had lights break. So right now I only have one light over here on this side and no light on this side because it hasn't come in. So it's a little wonky at the moment.
I have a question for the audience at home. For those of you watching, is that flashing real cube driving you bonkers like it drives me bonkers, or am I on an island on this one? Just let us know.
I love it. That's the only reason I have it going, is because it drives you bonkers.
It does. It absolutely.
But the best part is it's not flashing in real time. It's just a normal light. So why does it flash here?
Jeb, all I'm saying is I heard like 3 weeks ago that Counterman was going to get out the CAD and he was going to draw up designs and we're going to have intricate built-in lighting. And then next thing you know, I got these shelves and new lighting. I'm a little underwhelmed after what you told me. Thank you. This is spectacular. Baby Priggs says driving me crazy. So I'm not the only one.
No, let's just let's turn it off, Josh. I mean, if it bothers them, then I'm happy to turn it off.
Oh, that's a different remote. I thought you were going to hit your stream deck and you were going to start doing some of your recorded noises.
No, I can put I got one called Josh Fart on here. Should I hit that?
I don't think the home audience wants you to use your...
Anyway, we're moving along. Someone asked about mattress purchases, Josh. I mean, we're that's where the show's gone.
No, I like this. We're going to try and get a sponsorship. We'll get a mattress sponsor. So Willing says, what kind of mattress do you have? Foam, hybrid, spring? So I want to know, Jeb, because like 3-4 months ago, you were ordering the correct mattress. So the Lewis family, we have what do I have? A Helix Midnight Lux Black. And it is the most wonderful mattress ever. And when I'm away from home, I can't wait to get back home. And Jeb was going to get one, but he ordered the wrong one.
I did. I ordered the wrong one. So what happened was I went in there and put it all in, and I went back and changed something. And somehow when I placed the order, I ordered a queen. And I was like, and I didn't know until after I did it, called them immediately. And they were like, "Oh, we can't do anything because the order is gone."
That was 3 minutes ago. It's on its way out the door.
I'm like, this is crazy. And so they had to wait till they sent it out to me for me to then request to send it back. And then it took them like 3 weeks to give me my payment back. So after all of that said and done, I never reordered it because I was kind of pissed with the whole process. So I'm still sleeping on the same mattress. I don't know what the name of it is, Josh. It's like a King and Foster, a Foster Helix. And something.
You don't want to, you got to go back and reorder
no, I do,
your Helix.
But I haven't done it. That's what I'm saying.
So I need to get 2 more for the place in the desert because when we sleep in different rooms out there.
If you work for Purple or
Helix, or you have any type of connection on
or
any
the one that
stuff,
fools you like that, I'm all game. I'm willing to try your product out and let you know what I think of it, an honest review, and go from there. So anyway, let's see. Alex says interested in a home in SoCal that it will be 50% of my income. Josh, what are your thoughts on that?
It's aggressive. So let's say this, if you're 50 and you've been getting 2 to 3% a year raises, and it's likely to continue that way in the future, you're going to have 5, 6, 7 years of it being real tight unless rates drop a lot and you're able to refinance, which we don't have guarantees of that. I would not count on it. It's tight. What I will say is we do have borrowers that do that they have money that they know is coming in that we can't qualify for them. Talking to someone right now, she tutors kids on the side. It's $1,500 a month. We can't use it because it just goes into her pocket, but she knows that it can go towards making her $3,000 a month mortgage. So if there's nothing else there and you're not 28 and hey, I'm due to make partner at the law firm in 2 years and my income is going to go up $100,000 a year. I would just be very, very deliberate and thoughtful about it.
There you go. Yeah, 50% is aggressive if you don't have more income than actually reports on your tax return. So if you're truly 50%, I think I don't think that's a smart move, personally speaking. Josh, can you make an extra payment to a mortgage and request that it goes directly to principal when doing a house, when making a payment rather?
Absolutely. And I would say 90% plus of people, everyone under the age of 60 these days is making their payment online. And when you go in, it will show you that. You can push a little button that says make minimum payment, make an extra payment. How do you want the extra payment applied? So you can absolutely do that. And you can set that amount up every month. If you go, hey, if I make a $340 a month payment, I cut 7 years off, you can set it up that every month my auto payment goes with a $340 principal payment. So you 100% have that control.
There you go. Earlier in the show, we mentioned that we are doing a webinar, a seminar on January the 28th at 5 p.m. It's a Tuesday, Pacific Standard Time. It'll be 1 hour long. And this is a full buying, walkthrough, if you will. It is a blueprint to buying a home, whether it's in March of 2025, December of 2025, or mid 2026. It's essentially what you need to know in order to go through that process. So if you're somebody that's considering buying, it'll be worth your time. Again, this isn't a sales thing. It is really just education. And if you know somebody that could use this, let them know. Again, the website is jebsmith.net/seminar. enter your information. You'll receive the link, and then we'll be ready to go on the 28th, and we'll walk you through that. So it'll be a little bit different than this because it'll essentially be Josh and I educating, teaching for an hour. There is a comment section where we can answer questions at the end, but it is not a Q&A. It is true education in the sense of just guiding you from A to Z. So if you're interested, check that out. Josh, any questions?
Do you know what time it is, Jeb?
Hammer time?
It's that part of the week when my brain fires up and says, I sure wish Wingnuts didn't go out of business.
Ooh, that happens every Wednesday.
Every Wednesday.
Yeah. If you're an entrepreneur, a restaurateur,
go buy the recipes from Wingnuts and open.
No, just open a wing plate, like a good wing. Just buy good wings. Don't buy shitty wings. Buy good wings. Spend a little bit more money. You could charge more money, and just open a wing place. That's all we want. I don't want you to serve burgers and just serve wings. That's it.
Jeb,
and chicken tenders, and you're good.
The best wings, the best replacement wings I found are over at Rip. They only have like 3 flavors.
They're good.
But those are good wings. Those are good wings.
They are good wings. But again, you're limited. I want selection. I want a lot. Anyway, that's a lot, guys. The show is really taking a turn for the worst in 2025, guys. We're
talking about our eating habits. I need to get 200 grams of protein in today, Jeb, so I could go and eat like 30 wings.
We have literally just gone off the deep end, and I'm sorry. After 4 years, you've answered essentially every question there is, and Josh and I no longer even like each other at this point. We're only here for you guys. So, yeah. But anyway, as we started the show, sending prayers, positive vibes out to LA. If you're, know somebody that's been affected, reach out to them, let them know that you're thinking of them. Those people are going through a lot and need a lot of positive things headed their way. So, we got another question here, Josh, from Steve. What is the typical to expect when selling a home? That's a really open question. What is the typical
the
time
typical
frame?
What, Steve?
Typical
timeline, cost, expense, closing costs.
There's a lot that goes into that question. If you want to kind of elaborate a little bit more, we'll try to answer it here before we head out this evening.
We have a vote for salt and pepper chicken wings, and then Wheeling back.
I'm down with that.
Orange chicken sesame. I don't know about that. That's
orange chicken. Ooh, that's good on fried chicken from Panda Express.
Ooh.
Well, that sounds delicious, actually.
It'll put you into a coma.
But I'm a dry rub. I'm a dry rub for the most part. Just lemon pepper, salt and pepper.
I go both. I can do a good sauce. I can do a good rub.
I mean, I can, but that's prefer. If you are looking for a real estate show, a mortgage show that talks about food, you might have found the right avenue. This might be it. I don't know what Steve's question is, but Steve, if you send us an email, we'll make it part of next week's episode. But until then, guys.
Cost. There's Steve. He comes in at the 11th hour.
Cost. What is typical cost?
He was cooking. He was cooking wings while listening. He wasn't there.
You should expect to pay, depending on whether you're paying buyer's agent compensation or not. If you are, you should expect to pay somewhere between 5 to 7% in total cost in selling in California. Other states might be a little bit more. If you're not paying buyer's agent compensation, then it's going to range probably between 3 and 4% in California. So hopefully that's helpful. There's a lot of fees in there. The majority of the fees that you're paying is compensation, title, escrow, that stuff equates to about 1%. So whatever you're paying in compensation plus about 1% is typically what you'll pay in closing costs in California.
Yeah, and that California part is important because we get around the country, you can have all sorts of transfer taxes that you're not going to be happy about.
All right, guys. Till next time, buy right, borrow smart, build wealth. Adios.
Stop cutting me off, bro.
I did.
You